positive close today would put the WTI up 7 days in a row. Has the focus shifted to demand the last few days? We saw strong jobs data on Friday, or are we rallying on expectations of an OPEC cutter, possibly both, Bob?
Yeah, good morning, Ben. Happy New Year to you as well. I think it's okay to still say Happy New Year for this week and this week only. It is shifted somewhat to demand, but more shifted to a balance of the two things. If you remember when we got the sell-off, this huge sell-off that took us back down into the 40, essentially that was on weakened demand. Then we got the announcement of the OPEC production cut, and people started the same usual rhetoric with OPEC on how they would cheat and there would be excess production versus the cut. But I think people were forgetting that in the last OPEC and Russian production cut, compliance was 116% of the promised production cut. And I think as that reality started to sift through the market, whether it was made up mostly by the Saudis or not, which it was, it doesn't matter. The overall reduction to crude oil supplies was there. Now we've got talk of the Saudis making a big splash in this production cut. There are some indications of a reduction, a future reduction in U.S. shale production. And then you've got Powell's statements and the possibility of a U.S.-China deal taking some of that potential demand slowing out of the market. So it's not just demand, it's also an increased speculative view that production is actually going to be reduced, not just by the OPEC-Russia production cuts, but by some of the indications that shale may be slowing in the coming months.
Hey, Bob, are you surprised to see crude higher this morning, considering the World Bank and others have been cutting growth forecasts?
No, I'm not. I mean, you know, last time I talked to you, Ben, I said crude needs to rally, but we weren't buying it yet. We bought it recently, and we're looking for this basing to kind of take hold, not in the way that it did when we got back up to 76 a few months ago. You know, OPEC's talking about wanting 80. I don't think they're going to get 80. But you look at a handful of things. You look at the seasonality. Seasonality generally starts a bid in about 3 to 4 weeks. You start to get that seasonal bid as speculative traders start to build up toward that increase of summer driving season. Now there's something that could actually slow the summer driving season. That's a polar vortex event, but we can talk about that another time. You could start to see some really aggressive winter weather. It's possible. AccuWeather starting to forecast warming above the polar ice cap, which releases the polar vortex, pushes cold air down north and northeast, which by the way will also affect natural gas. But having said that, that could push the summer driving season back a couple of months. But short of that, no, I think we're going to see reduced supplies. According to Rystad Energy, there were 44 shale jobs a day happening. That's down from 48 to 50 between May and August of last year. There's a drop in that. Dallas Fed is also reporting a little bit of reduced activity in the Permian. This goes along with the prediction and then the forthcoming lower prices that shale saw. And then there's another thing in terms of stabilizing prices. We're going to get pipeline capacity. We've already got about 100,000 barrels that have gone online. The Seaway pipeline has added about another 100,000 barrels. Now, adding to that, you're going to start to see some of these other pipeline projects come online in the second quarter of 2019. That is an interesting dynamic for price. Shale needs to reduce their price versus WTI when the cost of transport is high. If the cost of transport drops, they don't need to price cut. So that actually ends up stabilizing prices versus the WTI benchmark. So there's a lot telling me that prices are going to stabilize and possibly rally up into the high 50s.
Well, it sounds like we should also be dialed in on infrastructure as shale production continues to increase. Bob, let's talk a little bit about inventories, because that's another big piece in the puzzle. Yesterday on the close, the API reported a large draw of 6.270 million, and today we have the EIA, which is expected to report a draw of around 2.8 million. Bob, are inventories going to become the focal point today, or will be the dollar potentially as it continues to come off?
I'd look at two things today with the EIA report. I think it's going to be a little bit more of a draw than expected, and I'm basing that off of last week's refinery utilization jump. That was a big jump in refinery utilization. That's the short-term indicator for me, very short-term. I keep track of the refinery utilization and I roll it about every 3 weeks in order to not get skewed by something that happened 3 or 4 weeks ago, because refineries are the one part of the sort of crude oil chain that can actually turn the spigots off or turn them on. People talk about shale, they don't just turn it on and off, refineries do. So we saw a jump in refinery utilization. That's a jump in immediate demand. So if you see that again, you'll see another miss on build versus draw, which is what we got last week. We're expecting a draw now based off of that refinery utilization figure.
Bob, I'm wondering, will the looming trade war, the US dollar, and record shale production be the hurdles for OPEC in 2019?
Well, it depends. Again, I've mentioned some of the slowing we're seeing in shale now.
Yeah.
We've got record production, but that's rear view mirror. Right now, we've got shale jobs reducing. We've got CapEx down based on the recent prices. Again, Ben, these things don't happen next day.
Yeah.
We don't get an increase in shale, and then all of a sudden we get a cutoff in shale. They kind of drip away, and that CapEx has been reduced. So I don't know if it's as big of a problem as the front month has been stating. I think that's why we're seeing this rally.